want to get more reaction to the tit-for-tat trade war we're seeing out today. And joining us now is Milken Institute Chief Economist William Lee. And William, last time you were on the show, you were talking about how President Trump was right to call for more action from the Fed. And now we're seeing this trade war heat up now as China moves. Curious to get your thoughts on how President Trump might choose to react.
Well, I think President Trump now has put Chair Powell on notice that he's got to do something. And Chair Powell, I think, hasn't quite come through, in part because he's got such a split committee that he really doesn't have command over the full monetary policy apparatus the way former chairs have. But putting that aside, President Trump now is dealing with retaliation, and I think he's trying to demonstrate that he's not going to be shoved around by another tough guy on the street. So he's going to try to come back and act as tough as he can. But look at the end game. President Trump needs to have a political victory, and also President Xi has to have a political victory, because in October, he's got to go in front of the Chinese people and say, this is the 70th anniversary of our revolution, and we're on top of the world. In order to do that, he's got to somehow say that we either have won the trade war with President Trump, or we've got him to a place exactly where we want him. And that's far from where we are now.
William, just to be clear, is it the job then of the Federal Reserve to implement monetary policy in order to try to fix some of the concerns that have been brought about by President Trump because of this trade war and the way that it's played out at this point?
Very good point. Monetary policy has the objective of maximizing growth and full employment in the United States and price stability. And that's the full objective of the Fed. Now, President Trump's trade uncertainty and all of the trade wars has really threatened the possibility that U.S. is going to be able to grow at its potential. And as a consequence, monetary policy has to be ready to do what monetary policy did all over the world. Remember when Europe was falling apart because of Brexit, because Greece was falling apart and potentially Italy? President Draghi came out and said, we're going to do whatever it takes to make sure everything is okay. Chair Powell hasn't quite come out with as strong a statement, although his latest speech says we're going to do what's appropriate. Not quite all it takes, but he's trying to get there. And I think he's trying to get there reluctantly, pulling a very reluctant FOMC with him.
And William, when we look at this too, I mean, we just heard from Chair Powell today, and it was kind of a mixed message. You're talking about trying to come out and say that everything that needs to be done will be done. But when you look at it, he also said inflation seems to be moving closer to their 2% target. So I'm curious to get your take on really, I mean, as Emily mentioned, when we talk about the dual mandate, if the data is pointing to things not necessarily deteriorating as dramatically as you're pointing out here, what kind of message can they be sending moving forward that they are in line with the president if President Trump continues to attack Chair Powell and calls him an enemy on the scale of China?
He's an enemy toward maintaining maximum growth in the United States. And I think because he's failed to instill the confidence in CEOs to maintain their investment spending. All the GDP numbers this year have shown that the investment boom that came about because of the tax reform last year has stalled all throughout this year. And without investment, business investment in plant and equipment and research, we're going to see that real wages are starting to go down, productivity will go down, and possibly if there's enough uncertainty, employers are going to start to put off hiring and start shutting down hours. That's the threat to the consumer. That's the threat to our recovery. And unless Chair Powell is able to convince the rest of the FOMC that we have to stand behind growth, that is a real threat. And I think that's the kind of threat that President Trump is trying to point out, that we need to have a backstop to growth using all of the economic policy tools, especially monetary policy.
Well, whether or not he gets that in terms of the September rate cut that he wants so bad, we'll have to wait and see. But when we talk about what can be done, President Trump, what he will now do, I mean, there is only so much you can do before this actually starts to hurt what has been the last bastion to hold up here in this trade war, that being the U.S. consumer. But now we're seeing if these new round of tariffs that he wants to put in come September and then December, it could add up, some researchers say, about $1,000 per U.S. family when we talk about the actual impact here. Is it starting to become a very dangerous thing to start playing with that last piece of the economy here in the U.S. that has held up so far?
Zach, be careful. I think President Trump is going to be a little bit more expansive than just tit for tat with another round of tariffs. I think more importantly, in order to make really China hurt, in order to make sure that our punch lands, he's going to try to say to ZTE and Huawei, You need our industrial products. We've given you a pass so far in allowing you to buy the commercialized, commoditized products that the U.S. producers produce that you so need in your supply chain. Well, we're going to start cutting that off, right? And I think that's probably an integral part of the next step in the trade round. Not so much tariffs, but rather administratively making our supply chain much more restrictive to China. So that's going to hurt China much more than any kind of tariff we put on.
That might be true, but you'd have to wonder what the market reaction might be to that, as we're already seeing today as things move in the opposite direction, further away from a deal. We're seeing the Dow fall 500 points, so I don't know what might play out if that actually does happen. But when we look at the flip side, right, we were fearing that this could spill over not just a tariff war, but then it became a currency war when we looked at China's moves. And then a lot of people were fearing that last step that China could take. I'm curious to hear your thoughts on what could happen if China starts to mess with the U.S. reserve holdings that they have. When we talk about the debt that China controls here, how worse could this get when we see what tools China is actually pulling?
If China starts to play around with dumping U.S. treasuries, that would truly be shooting themselves in the head, because that kind of market disruption would hurt their holdings much more than anything else. I think what China can do is start to allow the renminbi to depreciate much faster and allow that to offset whatever tariffs we put on. And I think that's the kind of game that President Trump is trying to avoid by using these administrative measures to try to choke off the supply chain that China so needs right now.
Why do you say shooting themselves in the head? Just real quick, want you to elaborate on that.
Disruptions in the fixed income market, because they have these huge holdings, they can't possibly dump all their holdings at once, because what would they buy? Euros? So because they can only do a little bit at a time, the large economic and financial market disruptions in asset prices would hurt them much more as holders of U.S. assets.
All right, there you go. William Lee breaking it all down for us. Appreciate you taking the time, sir.
Thanks for having me.